Two Fed moves just confirmed the great housing reset. Homebuyers should get ready for action in 2026. Hi, it's Steve Moon, your San Jose Metro Realtor. If it's your first time here, welcome to my channel. On this channel, we talk about everything that's San Jose Metro and real estate related. For anyone watching the housing market, the last few years have been like being stuck in concrete. High prices met punishing interest rates, creating a brutal environment for buyers and homeowners alike. But the winds are finally shifting. Redfin, one of the biggest names in the real estate business, recently released a major forecast for 2026, and they called it the Great Housing Reset. They described a slow, steady, and necessary road back to recovery. Then, just a few days after Redfin's report landed, the Federal Reserve, the central bank that controls the foundational cost of money, made two critical moves. These moves didn't just confirm Redfin's forecast, they essentially put the entire recovery plan on a new turbocharged path. For more than 3 years, the Fed's single goal was to fight inflation. And they did this by raising interest rates and, crucially, by aggressively shrinking their balance sheet in a process that they call quantitative tightening, or QT. QT was the financial equivalent of draining cash out of the system to cool down the economy. But the new announcement signals a massive U turn. First, they cut the federal funds rate once again. This is the baseline cost of money for the banks, which signals that the overall borrowing cost should start to ease. And this was already done twice before this year. Second, they announced that they will start buying $40 billion worth of short term treasury bills or T bills every month. This second move is the single most important action. It's the first major reversal of their contraction policy, or QT, that they followed for years. It's the Fed saying through its action that their time spent draining financial liquidity is over. They're now actively re-injecting cash back into the banking system. They're basically flipping the switch. The shift is a financial engine that confirms Redfin's analysis, but also gives the housing reset a turbocharged boost. Before exploring the Fed's impact, let's quickly review Redfin's top 5 predictions. And this is the blueprint for their predictions of the recovery for 2026. 1. Mortgage rates will hit the low 6% range. They expect the 30-year fixed rate to average around 6.3% as the Fed cuts rates to avoid a deeper recession. 2. Affordability will finally improve. So home price growth will slow to about 1%, and this slowdown will allow steady growth in people's wages to finally catch up with the rising home prices. 3. High costs will reshape households. So people will adapt by increasing things like multi-generational living, friends buying homes together, and adult kids staying home longer periods of time in order to save money for housing. 4. Policymakers will unite around supply. The crisis is too severe, forcing politicians to finally agree on structural fixes like zoning reform to increase housing supply, and in California, cutting back CEQA regulations to build homes much faster. 5. Home sales will creep up to about 3%. That slightly better rate will tempt buyers back into the market, leading to a small bump in transactions for 2026. The most painful issue for buyers is the mortgage rates. The solution here is the $40 billion T-bill purchase. For years, the Fed used a financial vacuum to suck cash out of the banking system using QT, as discussed earlier. Now, with the $40 billion monthly purchase, they've reversed the motor essentially. They're now putting $40 billion in cash into the financial market every month by becoming a massive buyer of government bonds. And when the Fed buys bonds, the demand for those bonds goes way up. And when the demand goes up, the bond prices go up. And when the bond prices go up, the interest rate payout or the yield on that bond goes down. Why? Because when the demand increases, you don't have to pay higher rates to those bond buyers. This is the Fed using its immense power to actively force bond yields on a downward spiral. Since the 30-year mortgage rate is directly linked to those yields, this double pressure, the rate cut and the bond purchase, means that the rates are now much more likely to hit the low 6% range or maybe even into the 5% range much faster than the Redfin's initial cautious forecast had suggested. The most critical prediction for the average person is that housing will become more affordable because borrowing costs will get lower. And the Fed's new dual policy approach is designed perfectly for that ideal soft landing. The combination of the rate cut and the massive cash injection works like a setting the perfect cruise control on a long trip, managing both speed and stability. The rate cut is setting the cruise control. It cools demand just enough to prevent home prices from speeding out of control once again. It sets the manageable pace for the economy. The T bill or the cash injection is a gentle adjustment of the steering wheel. By injecting 40 billion a month, it keeps the financial system stable and on road, preventing sharp swerves on an economy into a deep recession. By perfectly managing both the speed or the price growth and stability or financial liquidity, the Fed ensures a stable ride. And this steady, measured environment is the necessary ingredient that allows our paychecks to finally start making some headway against housing costs that are running out of control. Finally, the Fed's recent move proves why they can't fix the entire housing crisis alone. This reinforces the need for legislative action. Think of the economy as designing and building a house. The Federal Reserve is the architect. The Fed handles the overall financial design or the monetary policy. They set the plans for the cost of borrowing money or rates and the flow of funds or liquidity. Our policymakers or legislators are the construction crew. The construction crew fixes the physical, the structural problems. They deal with things like zoning, local permit delays, and actual lack of building materials and labor, the issues that can actually cause restrictions in housing supply. The architect or the Fed can draw up the perfect plan for a healthy economy. But if the construction crew or the legislature are stuck with outdated blueprints or zoning laws and aren't building enough homes, the crisis will continue. The fact that the Fed had to make such an aggressive financial maneuver just to keep the economy stable proves that the core problem, our severe lack of housing, is too broken for the central bank to fix alone. This confirms Redfin's prediction. The pressure is now immense for our actual lawmakers to step in with structural solutions like zoning reform and genuinely increasing housing supply. And we are, at least here in California, seeing that the lawmakers understand their roles and are making changes to laws locally to allow for rapid construction of homes. And these new law changes include allowing ADUs to be built in backyards and to be sold like condos, relaxing CEQA enforcement efforts to prevent NIMBY efforts to slow down large scale construction projects, and building high density housing projects near transit hubs and allowing builder remedy to push through larger scale projects when cities fails to file deadlines for their meeting of housing goals set by the state. The bottom line is simple. The Federal Reserve has signaled a massive policy shift. They stopped draining liquidity and are now actively adding it back in, acting as a powerful financial current to push the housing market reset forward. The path remains a slow recovery, but the financial mechanisms are now aligned to make that recovery more stable, less volatile, and potentially a bit faster than we had anticipated. For the first time in more than 3 years, The biggest financial forces in the world are finally aligned with the average homebuyer in the form of a $40 billion monthly cash infusion into the US bond market. If you found this information to be useful, please hit that like and subscribe buttons, and I'll see you in the next video.